For 5 days in October 1929, the roaring market simply stopped roaring. It was a dizzying ascent. Throughout the 1920s, the American stock market had become a national obsession. Fortunes were made, seemingly overnight, as share prices soared. Ordinary people, lured by the promise of easy wealth, poured their savings into stocks, often buying on margin, borrowing money to amplify their investments. A rising tide, it seemed, would lift all boats indefinitely. But beneath the surface, cracks were appearing. Industrial production was slowing, and agricultural prices were plummeting. The market, however, remained largely oblivious, fueled by speculation and an almost unshakable belief in perpetual growth. Then came the first tremors. Thursday, October 24, 1929, known as Black Thursday, saw an unprecedented wave of selling. The Dow Jones Industrial Average plunged 11% at the opening bell. A brief recovery was orchestrated by a consortium of powerful bankers who pooled resources to buy up shares, creating a temporary lull. Richard Whitney, vice president of the New York Stock Exchange, famously purchased a large block of U.S. steel stock above market price, a theatrical gesture to restore confidence. For a few days, it worked. The weekend offered a false sense of security, a fragile calm before the storm. Then came Monday, October 28th, Black Monday. The selling resumed with renewed ferocity. Panic began to set in, but the true catastrophe was yet to unfold. The market closed down 8%, wiping out billions. As night fell, fear permeated New York. Margin calls were going out across the country, demanding immediate repayment from investors who had borrowed to buy stocks, forcing them to sell into a collapsing market. Tuesday, October 29th, 1929, Black Tuesday. The opening bell at 10 a.m. was met with a deluge of sell orders, far exceeding any previous day. At one point, 16 million shares traded hands, a record that stood for decades. The ticker tape couldn't keep up. Prices were hours behind, leaving investors blind to the real-time destruction of their wealth. General Electric, once a blue-chip stock, fell from $400 to $283 per share. Throughout the day, desperate attempts were made to stem the bleeding. Bankers met, but no coordinated rescue package materialized. The market simply cascaded downwards. The psychological impact was immense. People who had been millionaires in the morning found themselves bankrupt by evening. Fortunes vanished, dreams shattered. By the close of trading, the Dow had fallen another 7%, marking one of the worst single days in market history. The Wall Street crash of 1929 wasn't just a financial event. It was a profound psychological shock that heralded the Great Depression. The illusion of endless prosperity dissolved, replaced by widespread unemployment, poverty, and a deep distrust in financial institutions. It was a stark reminder of the fragile line between speculative exuberance and economic devastation. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're curious about the historical financial bubbles that shaped our world, subscribe to explore more stories of market manias and their human impact. This video is for educational and informational purposes only and is not financial advice. Always do your own research.